Kumba Iron Ore says it continues to build stockpiles at its mines due to persistent rail and port constraints. The stockpiles are swelled to 8.2 million metric tons in the first half of this year. The mine reported that interim earnings slumped 26%, hit by softer iron ore prices and the logistics challenges. SABC News markets presenter Nastassia Arendse spoke to Kumba CEO Mpumi Zikalala for more.
Improvement in terms of our total recordable injury frequency rate coming out at 0.94 relative to 1.2 for the same period last year. And I don't take that for granted because the essence of ensuring that all our people are safe and healthy is critical. And then if I look at the operational fundamentals, this is fairly much in line with what we've guided. We've seen a reduction in terms of our saleable production, so circa 2% reduction. But that's in line with the performance that we've seen on the Transnet side. And that was always the plan when we started talking about the reconfiguration of our business. More pleasingly for me is that when I look at the fundamentals around, efficiencies around both operations, Sishen and Kolomela, I've seen massive improvements. I've seen a 25% improvement in terms of our operating time. And that's actually allowed us to fundamentally strip out costs. And we've done that. We've achieved a 1.8 billion rand relative to the annual figure that we committed to of 2.5 to 3 billion rand. So more than halfway, even though we've only just gone through the first half. So I'm actually pretty pleased with how our teams have performed.
To those who may not have been paying attention to some of the adjustments you've had to make from a logistics side and how you've had to navigate that, talk to me about how you've responded to that logistics reality in order to remain competitive.
So, Nastassia, if you look at how we expect the logistics value chain to perform, we expect as Kumba to be north of 40 million tons per annum. And when we looked at how the overall performance of the system has essentially materialized over the last couple of years, we've clearly been challenged. And that's what got us to a position towards the end of last year where we decided to fundamentally reconfigure our business as a business that will deliver from a production volumes perspective between 35 and 37 million tons. And from a sales perspective, we've said 36 to 38 million tons. And that's simply because we got to the end of the third quarter and we were stockbound. All our on-mine stockpiles were full and we had started tracking out material to fill stockpiles. But the essence of the reconfiguration caused us to pause and fundamentally focus on stripping out costs. Sadly for us, that also came with the reality of having to go through Section 189 restructuring, where 490 of our roles have been impacted as part of this. And we've also had to engage with some of our contractor companies. And then if I then look back and say, where are we right now? So we committed on what it is that we need to do and where are we currently sitting. Clearly, as one of our key focus areas is the essence of working with Transnet and with government around the drive for an improvement in the logistics performance. And I've got to say that in as much as we haven't seen the results that we'd like to see, we've always said that we think that the turnaround will take a couple of years, and that's what we've filtered into the guidance. What I'm pleased with is the fact that our collaboration with Transnet is strong. They are very open and transparent around the essence of us assisting them. And then secondly, from a broader government perspective, I actually am pleased with what our new government has been saying around the aspect of policy reforms, because we've always said that one of the key things that has to come right is the essence of improving or the implementation of greater private sector participation.
Yes, and I can imagine you and I are both looking forward to that independent technical assessment, which you alluded to in the results presentation that will be out in the third quarter. But let's look at the market environment. What are you seeing in terms of demand within China as well as some of the other geographies?
So what we've certainly seen in the first half has been a weaker market From a China perspective, we've seen weaker demand, primarily driven by challenges within the property sector. And what we've essentially seen is that steel mills have continued manufacturing, and some of the output has gone into other export countries from a China market perspective. And that's what's essentially fed into that. We've clearly looked at what we believe will happen in the second half, and we expect prices to remain subdued at current levels that we are seeing if one looks at current performance. But as we know, the demand will pick up as China essentially heads up towards Chinese New Year, and that's part of the fundamentals of how the cycle works. But more so from our perspective as a business, we focus on the delivery of high quality material. So the essence of us looking at that is simply because we get to realize additional premium by virtue of the quality of our product. And that is our strategy. That's what we are known for, particularly when it comes to the production of lump. And we'll continue focusing on that because we do believe that that not only positions us within the current markets,